home goods cheaper for Canadians. Cheaper for Canadians, which I'll abbreviate as CAD, and makes Canadian goods more expensive. And this makes sense. So this is why exports will increase and imports will decrease, causing the balance of trade to increase overall. And a further explanation of this is because well, our currency, we need for Canadians to buy our American goods, they only need to spend a little amount of money to get a lot of our money to buy our goods. So essentially, our goods are at the same price, but because of our lower exchange rate, $1 of Canadian dollar can be worth more American dollars. So essentially, because of exchange rate, Canadians can buy American goods, which is domestic goods, for a cheaper price. And to buy Canadian goods for us, we have to shell out more of our American dollars for Canadian dollars, and that is why our imports decrease, because the price that we have to pay for those imports are more. So essentially, what I'm saying is that the foreign goods, the Canadian goods, are more expensive in this case. And I'm Canadian, and I don't know why I'm talking like I'm an American, but yeah. So other than that, there's something else that happens. Consumption increases, and I want to remind you that there's a low exchange rate and there's a high bond price. That means that if there's a low interest rate, then low interest rate, high bond price. If there's a low interest rate, then we pretty much keep more of our income. That's why we consume more, because we don't get taxed as much, and also investment goes up. Except the interest rate is low, then that means that we have more money. We can borrow more money from the bank, and we can invest that into our businesses and our houses. And that's pretty much the short run, or the immediate factors, that the immediate occurrences that actually happen. So in the short run, what happens is that in the short run, what happens is that oh, one more thing that I forgot. I forgot that the aggregate demand actually moves right in the immediate period. At 80 moves right from 81 to 82. I knew I forgot something. So let's just move our 81 to our new 82. That's a horrible line. Whatever. To 82. And remember that our price does not change. So this would be our point, and this would be what we call y2. And that is really off graph, but I think you will get the idea. So that is our y2. So, additionally, in the immediate period, I guess I can also say that y increases from y1 to y2. And that's really tight, but I'm sure you followed well. So in the short run, what happens is that price increases from P1 to P2. P1 to P2. Price increase. So in the short run for our graph, the price in the immediate period is here. So in the short run, we move our price back to the equilibrium area where AS intersects the new AD curve. And when this happens, it causes the interest rate, or before that, this will cause money demand to increase. And money demand increases from MD1 to MD2. So money demand increases from MD1 to MD2. So we draw a new curve for MD, and this would be our MD2. And this would be our new interest rate where they intersect, and this would be our new I3, and we can say that in the short run I increases from I2 to I3, and lastly y decreases from y2 to y3. Oh, did I forget to include the new price? I forgot to include the prudent price. So this would be P2, and that would be y3, the point where they intersect. So y falls from y2 to y3. And that's pretty much it for expansionary monetary policy. And without further boring you, I'd like you to, if you don't really followed me that well, I want you to watch this video again. Make sure you really understand it because this is really important. But other than that, please rate, comment, and subscribe. And I'll see you